All right, hey, welcome everyone. Welcome to the Hurley Investments Market View Commentary for the 14th of March. As you can see, for the first time in 2 years, I'm finally excited for our markets. I should have been there, except for first time in almost 2 years about the market opportunities. Now, there's a reason why I'm excited. Out of curiosity, how much have stocks fallen that we are currently in? And these are round numbers, but I'm going to let you guys tell me, what are some of the things that we're in that have fallen ridiculous amounts? Of course, Baidu, and we have 75%. First one that you guys mentioned, of course, Ford, 45%. I think that's pretty close as well. Under Armour, you guys are nailing them. 50% plus. I don't know exactly where we're at on that one. Apple, there we go. Apple's down. I'm just going to round up 18%. Mark says there's no sound. So let's we can all hear you, definitely sound. Mark, we'll just type in Mark. We are able to hear me, so maybe back out and get back in. All right. It looks like Mark's coming back. All right, there we go. Boeing. We have Boeing down 50% plus. Where's Facebook? Where's Meta? There we go. Facebook down 50% plus. Anything else we want to stick in there? Our banks have been doing pretty good. Visa's holding in flat. Disney, there we go. The last one I was waiting for. Disney's roughly down 35%. So for collar trading, what does this mean? And I think this is where we're all going to get it, or we're all going to start to understand, right? Get to add new shares. We are sitting, can't spell, on a lot of cash, and we are ready to add shares shortly. And it's rather important to have an understanding of what I'm talking about. It's rather important to take a look at where we've come from on some of these movements today, because it really, to a certain degree, hits home. If we just take a couple, a little bit of a look, right? Apple today down $84,000. We made up 84,335. We made up more on the way down on Apple today than the stock lost. That is where we're trying to see our returns at. If we take a look, anyone know how much was the S&P 500 down today? Anyone have an idea? How much was the S&P 500 down today? No, it wasn't down. Well, 31.2 points, correct. Or 0.074%, 73, that's excellent. You guys know, I like it. So on this group, nothing like seeing a positive number, and it's not huge, right? But nothing like seeing a positive number as a whole on this $17 million of equities. And the neat thing is it's not on all of them, but I'm going to go through on some of these here. Baidu, not the most spectacular. 136, made up 123. Disney, 52 on Disney, made up 46, and we have another set of 2,200 right there. Ford down 22,220, made up 1739. Just keep moving down. Facebook wasn't down too bad, only down 454, made up the 39 plus the extra shares of 570. Got to keep finding my other ones. I guess the short answer of why I'm excited for where we are at right now is Baidu. We have money to add 40% more shares of stock. Ford, we have 100%. Well, that's not saying right. We have money to buy 100% more shares of stock. And that's partially because we sold out at our high up at 25.12 to 25.22, half of the shares at that point. And we've been making up money on the way down in long puts. Under Armour, we can buy 40% more shares of stock. Boeing, we can buy 40% more shares of stock. Facebook, we already bought 66% more shares of stock. And Disney, we can add 30% more shares of stock. We are sitting on a pile of cash. Now there's an understanding of what we're talking about. So I'm just going to do it with a $100 stock, right? And I'm just going to put it in simple English. Buy to open a share of stock for $100. What's the risk in the trade? Of course, perfect. A couple of you typed in $100. So we've added long puts. Can't spell, sorry about it. Long puts at $100, and it cost, I'm just going to say $5 or 5%. New cost basis is equal to the $100 plus the $5, which is equal to $105. What's the new risk in the trade? What is the new risk in our trade? $5, right? Or 5% of total invested capital. So when the stock loses 40%, which is the range of most of what we can add our shares of stock on, right? When the stock loses 40%, we can add 40% more shares of stock. We have 140 shares with a cost basis of, and we're doing this on a per share basis, right? Of a per share basis. Let me just go through it. Goes down to $60. I'm going to say, well, I said 100 shares on this one. We'll just work out our cost, but 140 times. So I should actually put on here for 100 shares, we have a purchase price totaling $10K, right? And if the stock falls down to $60 a share, we lose 40% of the value. Just can't type today. Total value equals, well, actually, I should do it. Let's make sure I'm doing it correctly. Divided by 60, it's 166 shares of stock. Really? Is that correct? So if it loses 40% of our value, right? I said we can add 40% more shares of stock. Is that correct? Is that correct? Because I just made a mistake. No, it's not. If on 100 shares, right, we have the right to sell them at $100, that equals $10,000. Divided by $60 a share, that equals 166 shares. When a stock loses 40% of its value, we forget that chart. Let's see if I got that chart in here. There it is. When a stock loses 40% of its value, it actually takes us 67% to get back to break even. Well, Kevin, you're down that $500 for your protection. Correct. So if the stock gets back to, let's just say $65 per share, right? 166 shares times $65. Let's do the math. That's worth $10,790. Or in this case, it's an 8% upside. If it just goes up 8%, we're good. Let's say it goes to $75. And let's do the math. All of a sudden, our number comes out to be $12,450. And let's say our stock never gets back up to the highs. We're going to say it only gets back up to $90 a share. Right? we'll still end up with 14,940. I'm excited because our markets have moved and we have a cash hoard to buy more shares. And it's when I say a cash hoard, I need to put this into a perspective right now. We were pretty full valued not too long ago, right? We were pretty full valued. We're sitting on $2.5 million of cash. We cash in our puts on Apple, $318,000 we get to add to the 2.5 million. And it's just ridiculous going on down. Baidu, another $123,000. Disney. Ooh, actually, I just did that wrong too. I'm doing everything wrong. Let me go back to this. No, I'm not. Apple cash puts were 316. Baidu cash puts, they're worth $625,000. Just between those two, we almost have $1 million. Disney, 382,000. Ford, 14 grand. Facebook, another $122,000. I mean, we have over $1 million just sitting right there. And it even gets better as we keep going down. JP Morgan's on 40,000. Let me put it on pause for a second. Let me get off to our next screen that we use. Under Armour sitting on another 93,000. I mean, if I just do some math, 2.5 million cash and the selling of puts equals roughly another 1.65 million, or 25% of portfolios are cash. And this is kind of a round number looking at everything in a group. So Jeff Hall just asked, what's the trigger, right? What's the trigger? The trigger to buy low and sell high right now, a bottoming of the bearish trend after Wednesday's FOMC rate hike meeting, and probably a week after that meeting for tax selling, just where people are going to sell their stocks to pay tax. So if you were to ask me, so when are we going to really start to purchase stuff? Next Wednesday through Friday. I'm looking to back up the truck. To back up the truck and to put our money to work. we have been suffering downward movement, right? Can't spell worth beans today. And the cycle to go higher will net us plenty of new shares to also go higher. So here's the question though, right? Here's the question. What sectors normally do better in a interest rate hike environment? Anyone have a guess? What sectors do best in an interest rate hike environment? Not trying to be tricky here. I see financials, I see energy, banks, financials, because I mean, that makes sense, right? They get to make more, they get to do more. Well, I went more of a historical look. So historically, this is what it looks like for the sectors that do better. Which one comes out in first place? Technology, right? Why would technology ever do better in a higher interest rate hike environment? Someone tell me, why would technology ever do better in an interest rate hike environment? Why does technology, and Jeff, I'll answer that question in just a minute. Why would technology do the best? Come on, guys. I think I told it to you last week. Not better productivity, but that's a good guess. Their productivity doesn't really change. There you go. Perfect. William knocked it out of the park. They're cash rich. Technology companies are usually cash rich. There you go. I like Jim's. More money to reinvest in technology. They don't have to borrow at these higher interest rates. I'm going to pull one other thing out here, one other chart. Just to give you a look at what the market typically does after these new interest rates hike. Out of curiosity, which time period probably relates best to what we're going through? Any idea? Which time period probably relates best? Well, 87 was the crash of housing and overpriced housing markets and oil, right? By all my numbers, It's not the 87. I'm going to tell you it's the 97. So we're not the highest, but we're close. We're awfully darn close. And it's interesting because the point that makes all this look good to me comes back to earnings insight. And if you guys go and click on the handouts, you can download this. But as Keith and I were doing our research over the weekend, the earnings insights is pretty darn interesting to find out. We had very low numbers for 2 years. And the estimated earnings growth rate for the S&P 500 was only 4.8. If 4.8 is the actual growth rate for the quarter, it'll mark the lowest earnings growth rate for the index since quarter 4 2020, which is 3.8. Well, Kevin, that's not really good. 7 sectors are expected to report lower earnings. We had 65 S&P companies issue negative guidance. 20 S&P companies have issued positive guidance. The forward-moving PE is now at 18.5, which is below the 5-year average of 18.6, but above the 10-year average of 16.8, or really 17. It really comes down to this chart right here. Our forward earnings are coming in line versus the change in price. You ideally want to see this type of movement. Anytime you get that deviations on the low side or the high side, you're looking for a fix, and we're almost there. There is a ton of information in these 36 pages, an absolute ton. And it's not citing a perfect this or a perfect that. It's just a ton of information showing you guys where we could be heading in the relatively near future. So the question comes down to, and I'll get to that one in a second, Jim. The only real question, so to speak, right? When will the Russia-Ukraine war stop? Or, more importantly, be shoved underneath the carpet? When will it not matter anymore? Jim, you asked, with real estate rise will be short-lived as interest rates go up. I found a very interesting article that the housing market will pass, not this spring. The U.S. home prices are up 18.8%. In my area, we are in a housing bubble. All this article is going to talk about is nothing more than we have so outpaced home prices for income that there's not enough money to keep buying homes at this rate. So yes, even though we see real estate taking a second place, we will probably see a bump or a rise through this summer. and housing prices even more, if you are thinking of selling your home, the next 6 months might be ideal, but we will probably see a drop in the housing market prices because people just can't afford it anymore. And really the second issue, when supply lines come back on to, and I'm just going to give it 90%, we will see supply far exceed demand. You know what sector this might really help things go up in? When I say things, I don't want to say stocks, but what two sectors might really do well with supply lines coming back onto place? Auto, heads up, agree 100%. Used cars at the highest price of all time. If you have more materials in supply, it usually makes the demand go down and price go down. Healthcare. I'm only saying healthcare because they need to get back to doing the elective surgeries, and they've also been paying top dollar for their supplies. And I could put one more in here. Consumer staples, which is already a low one right there. We see supply chains come on, consumer staples, price will go down as well. All right, let me see what else I have here, because I had another section. I'm really excited earnings are too high yet. I'm going to go ahead. I'm going to say download the handout. And that handout is this 36-page key metrics here. Tons of information. I really found it interesting as I looked at where we're at and what's happening in our market. All right, big picture. I'm going to go against a little bit what we said, but the big picture is the Fed will have to raise interest rates. Russia, gas prices, the Fed's earning estimates wasn't the best. Went to California, paid $195 basically to take in, 28 gallons of gas. It was ridiculous. I've loved the memes coming around. Tom Brady had to unretire so he could afford gas. Way to go, Tom Brady. Unretire. Get back into the game so you can buy more gas. And you know what? That's an interesting conversation. William just asked, what if we put more money to you? If we put more money to you, or you've started in the last 3 months, yes, we're probably looking to put more of that money to work in the next couple weeks. Let me go to why this matters here at the very end. What this all means. It's not a familiar position to be irked so much, but it was an impossible feeling to avert this weekend. It is a culmination of geopolitical uncertainty, monetary policy angst or tightening, and what strikes us as glaring unrealistic earnings expectations. In other words, there were continued reminders that volatility in the stock markets remain high, and returns expectations this year should get dialed down. So it's going against what I just said, But what's one of the differences here? So I should say, what's moving our markets higher? Any idea? What would you guys say will move our markets higher? So capital flows, it's funny, you both said the same thing. Why not? I will see two of them. Capital flows into the US markets and personal income rising. Which I found very interesting because the last consumer credit report, we were supposed to have like $18 billion of consumer credit. Only $6 billion was spent. People are reining in their finances. Our typical last 2 months, I found pretty interesting because we're only 2/3 of the expected consumer credit number, and then only 1/3 of the expected consumer credit number. Really interesting that people are taking this seriously and have reined in their finances to a certain degree. Technically speaking, we're bearish on the Dow. I'm sorry. Where do I think our markets are going to go? Of course, you guys always look at that. I think they're going to go lower, only because of the Fed rate. So that's what I meant there, William. S&P 500, we're bearish, but not oversold. And we're bearish on the NASDAQ. Now, I'm just going to list a couple numbers because I think it's important to go from our highs that make our markets look a little bit cheap. Okay, I'm going to say that make our markets look extremely cheap. Where are they? Here we go. So I'm getting this from CNBC, right? CNBC last year, meaning I should say, let's do it this way. Rolling 12-month gains. Anyone have an idea what the rolling 12-month gains are for the S&P 500? Actually, that's not even fair. Let's just go 0.51%. Let's go to the S&P 500. Rolling 12-month gains. So going back the last 12 months, where are we at on the S&P 500 that was up 26 point some odd percent? Last year, right? $5.83%, or down 21% from the highs. And then if we go to the NASDAQ, rolling 12-month average, pull up the NASDAQ. Wow. It's down 5.55, or down just over 30% from the highs. The markets are cheap. the markets are becoming cheap, and they're probably going to get another 3 to 5% cheaper as we have our overreaction to the Fed hike. A couple people said, I think it's a buy the news kind of event. People are going to buy the news. People are going to buy the fact that our rates are going to go higher. I just don't see it. I just don't see it. Our markets are ridiculously cheap. In fact, one of my favorite sayings, and I would say it right now, everyone has, I can't spell, everyone has run out of the store when the whole market went on sale. I can't tell you how excited I am in a week if we see a little bit of a turn to cash in our puts, to put more shares to work, still probably saving 10% cash to buy puts if we need it. But to see a run, even if it's just a relief rally, just a relief rally makes us very profitable for the year. Just a 10% relief rally, we'd be ecstatic for the positions that we're in. All right. End of March, I still think we're going to be down 4%. If you look at a chart, we're already down that plus some. If we go and we look at March, boy, looks like we started off at least at 43.61, seeing at 41.73. Let's just take that math and do those numbers. Take 43.61 minus 41.73. We're down 188 divided by 43.61, our higher number. We're already down 4.3%. I would expect for a triple bottom. Watch us test that P1 pivot point line. Little bit of scare in the rate hike, come down and touch it, and make a run back up to the 200 and the 50-day, which are just touching right now. Little scary, we're getting pretty close to a death cross. Pretty close to a death cross here. All right, FedEx, GameStop, Dollar General on Thursday for earnings. Housing starts, building permits, industrial production. I mean, not much will really move our numbers except for the FOMC rate meeting. So tomorrow, expect a pretty flat to little down day. Wednesday until the last 2 hours of the market, you'll see some volatility down and up, down and up. We might add some short calls on a couple positions to play volatility. But if you look, someone actually asked me, what about Baidu as it scares me and the humanity issues over China? So let me put a couple questions in about Baidu, a little bit of research here. So number one, right? And I'm going to say this politely. Number one, to my knowledge, we've never delisted a stock over humanity atrocities. Good spelling again, huh? To be pretty polite, money speaks louder than human atrocities that are occurring. Well, Kevin, supposedly there's 1 million bodies that they just killed out of the 1.6 billion. Hey, right now they're quarantining a city of 100 million people because of COVID. I get it. It's awful. It's not what you want to hear. But to my knowledge, the stock's never been delisted, or big money really hasn't moved out of human atrocities. We're dumber than that. Money will move out of Smith & Wesson and Winchester because they make bullets, because they make guns. Human atrocities, I should say, in another country, don't matter for those of us here in the US. Big money wipes underneath the carpet. Number two, they were not one of the 5 companies, not one of the 5 companies listed in the SEC report. In fact, the main ones that you do want to pay attention to, BABA and Yum China. The other ones, for all intents and purposes, were nobodies. And knowing BABA and Yum China, they'll get their paperwork in. They'll get their paperwork in. And number 3, which I found very interesting, and I'm truly getting this from a $5 billion equity private investor, a $5 billion fund manager over the weekend had a talk with me and basically said, if BABA, Baidu, JD, NetEase, Baidu, JD, NetEase, he didn't mention Yum China, Baidu, JD.com, NetEase, there's one more. But if they delist our shares will relist on the Hong Kong, and there is billions of Asian money waiting to invest into their own regional shares. Oh, there's one more I'm forgetting. Baba Baidu, JD, NetEase, and it's not Yum China, but basically there are tens, if not hundreds of billions of dollars waiting to invest there because it's duly listed and that the shares already are listed there for Baidu. But there's only a certain percentage they can go in because the majority of the shares are held over here. You want to see the share price double? For crying out loud, delist our Baidu shares so our shares will sit over there on the Hong Kong exchange and will double in value relatively quickly. That's what we're waiting for. Okay, I have an interesting article about Boeing. It won't show up very well, so please read through this. And actually, you're probably just going to have to click on the link. I'm probably going to have to take this one out, but click on the link if you're in Boeing. You'll see some of what we see. The housing market, I read from our own little Utah paper. I know it comes from elsewhere, but pretty interesting. Read about this. Mansion Day came out against the Fed nominee. So our poor gal, Let me get this faced. Sarah Bloom Raskin will most likely not run or get put on the as the Fed chair, which keeps a very liberal member off. That's it. Thank you, Ida. It is 10 cent. 10 cent was that one I was forgetting on those 5 Chinese stocks. But hey, we're going to see a progressive or a liberal Fed chair that might want to go to negative interest rates, not become the vice chair. I found this very interesting. It shows you where our world is heading to. Out of all people, Kim Kardashian got backlash. Part of it was because of the way that she said it. But she was basically asked, what could young women do in business to get a step up, right? Kim Kardashian is on the receiving end of heavy criticism this week after dishing out some eye-popping advice to women. One career coach telling CNBC her comments potentially sent a dangerous message to younger followers. Here's what she said. Get your effing butt up and work. It seems like nobody wants to work these days. So that's what was said, right? Obviously, a better way she could have said it. But the backlash she got was unbelievable. That people think that that telling young people to work because they're not doing enough was a bad thing. A very interesting article. I mentioned it last week. Please see where some of the things are changing in our world here. Very interesting article about Facebook, why we basically have said, hey, at this time we're still sticking with it. It's cheap, its multiples are down, but its metrics, its numbers still tell a pretty interesting story. I took this on the 9th, so this is about, what, 7 days old? Facebook lost 40% of share value. This is digging into the numbers. If you want to see why we still are adding shares to Facebook, this is the information that makes sense. And it all comes down to numbers and that, hey, people are still using Facebook, WhatsApp, Instagram, Facebook Messenger. They still run social media for all intents and purposes. All right. Boy, there's a lot in there. Another interesting article, and this is after someone sent me a comment about electric vehicles. Ford interested in powering homes and the grid. They're getting so much information about Ford, and now that they're looking at having over 300,000 pre-orders, even though they're not accepting up to 50,000, their limit was 250. They're now saying that they can power some homes, which is pretty interesting because I found another article here. I think you might find this interesting. And I really want you guys to read through this. The power grid where we're all going to be doing electric vehicles, the numbers don't add up. And I like that Ford's taking the stance, hey, not that you need to buy an electric car, but the electric car can actually power your home for a certain period of time or give energy back to the grid. You want to see if the electric cars are real? I couldn't quite figure it out. Definitely go through and read this article that the numbers don't add up. It doesn't make sense that we're going to have all these electric vehicles when we can't have a grid that would support not only the charging, but we'll need to pull from these electric vehicles just to keep the grid up to pace. All right, guys, what questions do you have? What questions can I answer for you tonight that maybe I've missed in our conversation tonight? And by the way, for those of you that are on, you should have a little handouts article that if you just click on it, it'll download the S&P information that Keith and I spent and studied this week. If you just click on that handout, so it'll be right there for you to double click on, and it'll download to your computer automatically. No questions? Well, if I don't see any questions, it's time for us to move. It's time for us to put some stock positions back in that have been 100% paid for. We don't just automatically add it. Thank goodness we didn't, right? We're waiting for a bottom. We're waiting for a little bit of things to turn, but we're really anxious because these 40% drops, on some of these we can add 60% more shares of stock. On Ford, we can add 100% more shares of stock. On Under Armour, we can add a lot more shares of stock. On Disney, we have at least 20 to 30% more shares of stock. We are excited that in that circle or that business cycle, right? We've kind of had, how would I say this? We've kind of had a pretty up cycle. We're in our down cycle. For right now, we're pretty close to that bottom. We're on the S&P 500, on individual shares. We're time to buy stock, and we're looking forward to this part heading back up. That's where we're going to make a lot of difference. I don't see any questions coming in. Guys, have a great evening. We'll make sure Dave gets this posted tomorrow. Don't see anything coming in. All right, guys. Hey, have a wonderful evening. Look forward to talking to you guys on Thursday. And pay attention on Wednesday, that Fed rate hike. It would not surprise me to see a really overblown reaction. They sometimes call those a blow off top, right? Where you see things just get ridiculous, and when everyone else is selling, that'll be our time to buy. Guys, have a good evening. Look forward to seeing you on Thursday. Good night, everyone.